Well, welcome everybody. Thank you for coming. Firstly, can I acknowledge that it's a difficult time in the world at the moment. Lots of challenges, lots of tragedies, things that we're struggling constantly to get our minds around. It does put into perspective, I think, the concept of investing in the next IPO or what our next investment is going to be. I think it helps to keep perspective at the moment of what's really important. But certainly on we go. On that note, I also want to acknowledge the passing this year of one of our earliest investors in Lorraine Topol. Lorraine was incredibly supportive of me and of River Capital along the journey, and we really will miss her involvement here. So that was a sad event this year. Can I take the opportunity at the outset, in case I forget at the end, to thank our River Capital directors. I can't see them, but I'll go through them. Our chairman, Jim Craig, Tony Robertson, David Vo, and Susie for their collective wisdom and humility. I know a lot of people say it, but we really do have a tremendous board, and I'm very grateful for their involvement. A busy and productive year for the River Capital business. This year we'd like to try and spend a little bit more time listening to you and answering questions and try to make it a little bit more interactive. So firstly we'll have a presentation from our guest company, the RCG guys, followed by some Q&A for them. Just in terms of the question and answer session with the RCG guys, they are in blackout at the moment, so they're doing us a big favour to come and talk. Obviously, any questions relating to their 2014 financial performance, which they'll be reporting on in a couple of weeks, are sort of off limits, but very happy to talk more generally about their business. Then we'll move on to the growth fund and the credit business, with plenty of time allowed in both of those for question and answer. So we will try to break things up and have Q&A in between, rather than having people wait and save questions till the end. Finally, the big boss, my wife and partner Susie, will offer some closing remarks. So we have allowed time for plenty of Q&A. Can I ask people to just be patient with the roving microphones, which will come round. That allows everyone in the room to hear and to participate. The final thing is, my son tells me there's an important show at 7 o'clock called The Recruit that he needs to be home for, so we've got to push for that. Okay. RCG. I'm really very pleased today to be able to introduce our good friends Ivan Hammerschlag and Hilton Brett from RCG. These guys have a unique perspective on River Capital. Both are investors in our growth fund and our credit fund. And at the same time, our growth fund's had an investment in RCG that's performed very well. What I love about this business and the guys that run it is that they inherited a failed IPO. And what they did, it was a business that was losing millions of dollars. And they rolled their sleeves up. It would have been very easy to walk away with the tail between the legs, but they rolled their sleeves up. And through hard work, today they've built up an organisation which this year will do significant profits, and next year, we're projecting even higher profits. It's a really nice business story of taking control of a business that's not doing well and turning it around. Many of you in the audience are involved in retail businesses or wholesale brands, and I think you'll enjoy Ivan and Hilton's perspective. So without further talk from me, I might take the opportunity to introduce Ivan Hilton. I'm looking around the room, but I can't.
Good evening, ladies and gentlemen. I'm Ivan Hammerschlag, and my partner is Hilton Brett. He's the guy that does the hard work. I'm the guy that does the pushing. Barry, works miracles, and he's asked us to build a miracle tonight to tell you our story in 15 minutes. It's going to be tough, but very clearly Hilton and I plan tonight to talk about the story of RCG, and rather than let it be an investor presentation, which we do all the time for analysts, we're going to talk just about the background. Hilton and I are both Australians who speak funny. I've been in the country for 25 years, and I think Hilton has been 16 years. We've been partners for over 15 years and really have worked together for that period of time. The RCG story is a very interesting one. I personally am a chartered accountant, been in retail for 40 years, was in a retail business in Australia when I arrived called Freedom Furniture. When I got out of it, I swore I'd never get into retail again. And after doing a whole lot of other things, thank God successfully, was approached by a fund manager who had invested in a float called Retail Cube Group, which had put 3 disparate businesses together. The share price was listed at 50 cents, and 9 months later it was at 8 cents. And very clearly the business was going insolvent. We had the courage to help them roll the board, put our own money into the business, and for a good period of 6 months, every Monday morning we were at Westpac in Bad Bank on our knees begging them not to pull the plug. The way I've built my whole business career, and Hilton has absorbed it and we've done it ourselves, is that we've always treated people around us as partners and family, and that is particularly in our staff and our colleagues, but more so in the investors who have invested with us. We very quickly realized that 2 of the businesses were no good. We liquidated one and returned, Hilton's more on the numbers than I am, what percent? 88 cents in the dollar to the creditors, which we were very pleased with. We sold the other business back to the guy who had sold it into the float. He thought he'd won the lottery, we knew we'd won the lottery. And we clearly left ourselves with a small business called the Athlete's Foot, which when we took it over was making just over $2 million. And this year, that's just completed. We're not going to talk close numbers, but it'll be anywhere above 12.5 million. So it's been a real success story, particularly because the business is franchised, and making profits out of franchise businesses are much harder. And the stores that are really under our control has only gone from about 125 to 145. So that was the first leg of the business. The second business was Hilton was the guy who kept telling me, in retail today, if you sell other people's brands, you're in trouble and you need to go vertical. And we were lucky enough to form an association with a business in America called Wolverine Worldwide Inc. That is one of the largest comfort brand owners in the world. And today we distribute Merrill, Caterpillar, Saucony, Sperry, and a small brand, Cushy, on their behalf, and literally have also opened up stores around it. That's the story. The market cap of our business varies dependent on what our government is telling people, between about 160, 180 million dollars. We've built a very strong platform for growth. I'm the old man in the business. Everyone is Hilton's age, and we're very excited about the story. But let Hilton rather tell you about each individual business.
Thanks, Arvin, and thanks, Barry, for having us here in River Capital. As far as the Athlete's Foot business is concerned, it's a business, as Arvin mentioned, that we have 146 stores across Australia and New Zealand, and has revenue in excess of $200 million. The Athlete's Foot business in the main is a franchise business, and really has built a remarkable market position in Australia, centered around the in-store customer experience and around fit. And through that, we've been able to extend the offer in the business beyond the core athletic offer of running, walking, and cross-training into other categories of fit. And today, we are the leader and the dominant retailer of back-to-school shoes in the country. That premium back-to-school market is a substantial market, and of which we today have around about 10% market share. And for us, the opportunity in terms of growth in the Athlete's Foot is one of those key markets, is the back-to-school market, where there's a clear focus from the consumer and the customer around fit. We, in the Athlete's Foot business, we've obviously identified that the in-store customer experience and the high levels of staff engagement and the customer experience is what differentiates us. As a consequence of that, we recently invested in the Athlete's Foot in world-class new fitting technology called Fitsy. This technology creates a much more engaging customer experience and really sets us apart and creates a moat in our business that differentiates us from the competitors. and that will continue to drive the in-store customer experience and drive like-for-like growth, which is the key sort of measure for all retail businesses, and like-for-like is what we have been focused on. And I would say over the last 7 years, this business has delivered like-for-like growths on average in excess of 5%. The Athlete's Foot is a very loyal customer base. We have in excess of 1 million members. We've recently invested in a multi-channel marketing platform called Adobe marketing platform, which was Neolane. It was recently acquired by the Adobe business for a multiple of 10 times revenue, which I'm sure if Barry was an investor in that, he'd be very interested in. But that really allows us to, and I think that today, from a consumer perspective, it's important to understand that one needs to be able to engage with the consumer on a one-on-one basis. And for us to be able to have a multi-channel marketing platform that allows us to engage with the consumers on a one-on-one basis, particularly a loyal customer base, is a key differentiator and is going to allow us to drive growth, increase the frequency of purchase of our customers, and obviously the product that we deliver to them. Other categories of footwear that we've extended the business into beyond that obviously require fit or in the duty category, travel and lifestyle. And as Ivan mentioned, one of the key, besides the differentiator for us in the Athlete's Foot around fit, we identified that we need to have a vertical presence in our business, hence the development of our RCG brands business, which has become a key focus, and a number of our brands now are important and critical factors, and Merrell being one of those. One of the key growth drivers for us in the Athlete's Foot as well is a partnership program that we've just introduced. As I mentioned to you earlier, in the main, and as Ivan said, the business is in the main franchised. In a franchise organisation, there are always opportunities where franchisees get a little bit tired and those stores are underperforming. We've created an initiative where we've been able to engage with managers who don't have the capital to be able to invest and buy their own franchise stores, which in our view are underperforming but are profitable, make in excess of $100,000 of EBITDA. And we've been able to introduce a program where we're able to acquire those businesses on a multiple of around about 4 times, which gives us obviously some leverage in terms of the returns. And that's going to be a key growth driver for us from a profit perspective moving forward, as well as the continued growth that we expect to deliver from the key categories that we've got in our footwear business. We've obviously, in the Athlete's Foot, we are the dominant, running is a dominant category for us, and today we are and still remain the number 1 premium running retailer in the country, and there is a strong focus for us to maintain that high ground and continue to drive that customer proposition. If I can turn to our RCG brands business, and that's a business that we started 5 years ago, effectively from zero, having identified that one of the key differentiators from a retail perspective is you need to have a vertical presence. As you guys will all be aware, ladies, a number of the brands today have a vertical strategy in this marketplace, and you're seeing brands globally deliver vertical in terms of going direct to consumer via online as well as in store. We started our business 5 years ago with being awarded the rights to the Merrell brand. The Merrell brand, we've grown that, doubled that brand over the course of the last 4 years. It's a highly profitable, differentiated brand. It's a brand that's sold on function and fit. It's the Nike of the outdoors. And for us, the beauty about the Merrell brand is we've been able to create a very strong vertical component of that business. Over the course of the last 5 years, we have opened 15 Merrell stores with an opportunity to grow that brand to 25 stores. The brand does circa $23 million in sales. When we took that brand on, it was doing sub $12 million in sales, and we believe that through growth in our own retail network as well as growth through the Athlete's Foot business, we'll continue to grow that brand. To give you a perspective, when we took the brand on in the Athlete's Foot business, the Merrell brand was doing circa $400,000 of wholesale sales. This past financial year, we would have come pretty close to $5 million. So it's very clear for us that as we continue to grow that business, a vertical presence is a very important part of it, and already we're sitting in excess of 50% of the Merrell business being vertical. Obviously, core to our strategy is our athletic business, and part of one of the recently acquired brands by Wolverine was the Saucony brand, or Saucony as it's well known in this marketplace. It's the number 2 specialty running brand in the US. We were fortunate that we were able to do an acquisition and acquire that brand from the Authentics business, and the owner of that business had such confidence in the strategy that he's actually taken the majority of his purchase price in equity in RCG, knowing that the Athlete's Foot was going to be the key vehicle to growing that brand. The beauty about our wholesale business and being able to grow a wholesale business independent of the Athlete's Foot business is that the Athlete's Foot is a full price retailer, hence other customers that may compete with the athletes would have no issue actually buying from their wholesale business as a result of the fact that the athletes would always seem to be positioning the brands in the best possible light. As far as the Saucony business is concerned, that's a business that does circa $9 million in revenue. We in the Athlete's Foot do about $3 million through that business, and we are confident over the course of the next 5 years we can double that business with the main growth going through the Athlete's Foot channel, and again, hence talking to our vertical strategy around the growth opportunity. Obviously, between Merrell and Saucony today, we sit at about 8% of the Athlete's Foot business in terms of the sales into that business. Our strategy is to grow that over time to 40%. That'll be achieved through a combination of the growth of our core brands being Merrell, Saucony, and this very top-sided brand, as well as securing and acquiring additional brands. And that really goes to the heart of our strategy as far as the RTG business is concerned right now, is to really focus on the growth of the Athlete's Foot business, but at the same time being able to leverage off the distribution and the premium distribution channel that the Athlete's Foot offers to the marketplace by securing these brands, growing these brands. These are iconic brands that we distribute in the business. They have very, very strong market positions. Both the brands are global brands in excess of $500 million in sales, and we see a substantial opportunity to continue to do that. The brands that we distribute are all premium brands. The other brands that we distribute is the brand Caterpillar. We have the distribution rights for both footwear and apparel across Australia and New Zealand. That's the only brand in our stable that is not vertical, but it's a brand that is known and well known in this marketplace to be one of the premium industrial brands. And with that brand, we see a substantial opportunity within a workwear category, which is a circa $1 billion. And for us, based on some of the activity, and I mean, a number of you may or may not be shareholders in Pacific Brands, it's created opportunities for us with a differentiated offer to take share in a market where Pacific Brands has undertaken. It's generally a very tough position through the trading. Our business is a business that generates very, very strong cash flows. We've been in a position where we've got a very highly liquid, strong balance sheet. We have excess of $10 million of cash. We've been able to deploy that cash to be able to acquire and secure brands. And in the main, through the building of our wholesale business, it's mainly been through the investment in working capital via debtors and stock and a small premium of goodwill in the acquisition of the Saucony brand. Strategically, we continue to focus on obviously driving our core brands and continue to look and identify acquisition opportunities. And outside of that, obviously one of the important factors for us in terms of continual return to shareholders in terms of earnings growth is a very high dividend payout ratio that we continue to be able to achieve in terms of after-tax earnings.
So before Barry starts asking questions, I want to talk a little bit about Barry. I've been an investor with Barry, I think, Barry, 6-7 years. And I've been on the other side of the desk with Barry that length of time. I want you to know we're all in good hands. When Hilton and I leave Barry's office, we go straight to the bar and have a couple of scotches. Barry, as far as we're concerned, really understands our business, and if he understands our business, he understands all his investee businesses. I don't know, I always play with Barry. I don't know if he makes more money for us or we make more money for him, but I want you to know that the way Barry analyzes our business, I'm sure he does for every other investment we're in, and we should all be very grateful.
Thank you. I hope we don't have any Pacific Brand investors or shareholders, but perhaps with the guys here, and sit down. If there are any questions, now would be a good time to put your hand up, and Zoe can bring a microphone around. And while you guys are thinking of it, I might just ask one myself. The sort of the question that you get asked a lot, guys, is the impact of online. We all have bought sporting shoes online and do it increasingly. I know when we first invested in the business, we were concerned about it. The profits have continued to grow, the share prices continue to go up. So it's been an incredibly good investment. But I'd be interested in how that online strategy is evolving.
Thanks. So Barry, as far as online is concerned, from our perspective, and we really look at it as far as the customer is concerned. And today, the world of retail has become multi-channel. So, in other words, being able to engage with the consumers consistently across all channels. When obviously we saw a surge in the Australian dollar some 3-4 years back, we questioned, we looked at the business and really wanted to understand whether the moat, as far as the in-store customer experience, was enough to really continue to differentiate ourselves. And we really came to the conclusion that for us, there was an opportunity with the internet to really leverage off that internet in terms of customer engagement, both with new customers and existing customers. And in that regard, we built a substantial online multi-channel business. We're able to use our online site to be able to engage with our customers. We offer the customers the ability to obviously shop online, but really from our perspective, we use our site to be able to engage and drive our consumers in store. As far as online is concerned, we certainly have, you've seen the brands across the world actually move towards protecting their markets because there's different cost structures as far as trading conditions are concerned in various markets, and what we're seeing is it being more difficult from a consumer perspective to be able to source some of those brands, and hence for us, obviously we always consider it to see it as a risk, but we feel we've mitigated it through the engagement on an online basis.
Okay. Other questions? Zoe, any other questions? Yeah, down the back, Zoe.
I will ask a question. Congratulations on building your business and looking after everyone. I'm sure all your shareholders are very happy with the past. Looking at your REM report and going forward, how do you work out, let's say, how to remunerate your staff and directors and people like that as compared to the rest of the shareholders? So do you have a formula going forward as compared to behind?
The truth be told, the bulk of the senior management of the business invested when we took over the business. What we did at that time was everyone stuck in a small amount of money, and we optioned ourselves up quite heavily when it was at 8 cents per share. In fact, Barry will tell you that when we initially raised our first capital from the market, Barry correctly said, "Are you guys going to exercise your options?" Which we did not at that time. But ultimately, what I did to all the young colleagues I had around me, I convinced them to mortgage their homes and exercise their options. And it has been a very successful event for all of them. So initially, all of the guys were rewarded with options. You'll have a look at our remuneration report and you'll see that our guys are not paid very high salaries in relation to market. We also have a share scheme where staff to a much lower level in the business is issued shares, and we really have a sense in our business of partnership. Everyone around our business feels that they own the business. Management and staff today speak for 20% of the business, so our interests are very aligned with our investors. I hope that answers your question.
Thank you, Ivan and Hilton, for coming and talking to us today. Recently, the Australian Productivity Commission issued a report on the cost of doing retail business in Australia, and I'm just wondering if that kind of industry study has any implications for your business.
Well, by the time you've paid your rent and your staff, there's really crumbs left for the owners in Australia. And I mean, Westfield have done an outstanding job over many, many years of owning every retail business in this country. The truth is, we have the highest labour rates in the world. We have the highest retail rents in the world. But in return, we do live in the best country in the world. So the answer is we sensing that the power between landlord and retailer is becoming a little easier. But then again, the equilibrium is still in their favour. I don't think any government in this country will ever have the courage to reduce the minimum labour rates. So we as retailers have got to be particularly smart. I think that our governments can do a whole lot more in terms of productivity, and hopefully it will be pushed through in the future.
Just a couple of questions. Firstly, you mentioned in your speech that you are buying some of the franchises and making them company stores. Do you intend to do that? Like, is there a conflict there?
Just to clarify, we're not making them corporate stores. We're actually buying them in partnership with incoming franchisees, and we've got a structure in place which allows those incoming franchisees to be equity holders in those businesses. So with the effect that we run them as franchise stores with obviously a little bit more oversight than we have in a normal franchise store, because we've got the balance sheet exposure in that regard. So there's no conflict. As far as opportunities are concerned, I mean, we've bought 6 stores, and we continue to obviously review opportunities as they go. We don't have a set sort of limit as to how many we would do. We did 5 in the previous financial year, and we would look to do a circa similar amount probably this financial year.
Also, in the main, these young franchisees who come in do put a small amount of money up. They might go and borrow $10,000 or $20,000 from their parents, and they own 20%. So we own 80%, and they have the ability after 5 years to go to 40%. So the answer is the success of Athlete's Foot is because a lot of our work is done across the lease line. Our franchisees work with podiatrists, chiros, sports clubs, schools, and having someone who's staked up in the business, who's willing really to go that extra mile is vital. We'll never turn them into corporate stores.
Sorry, and just one more question. How long do you both intend to stay in the business?
Well,
Good question.
The shareholders could fire us at any time.
A good answer. Elliot, I'll get back to you on that one. That's a good question. If there are no other questions, I might take the opportunity to thank... sorry, there is another one. Sorry, Jeremy.
The sensitivity on your margins to the Aussie dollar. You're importing most of your product over there.
That's right. So there's 2 sides to this in our business. There's the retail end, which is the Athlete's Foot, where all the product is purchased domestically. So effectively what I'm saying is that the franchisees in our corporate stores buy from suppliers, of which the RCG Brands business, our wholesale division, is a supplier to that business. So in that regard, there's no currency risk, and effectively what you're seeing is what you've seen over the past few years, maybe some small price deflation that's settled down, where you've seen pricing settle down, and if anything, you're starting to see a little bit of price inflation starting to flow through, particularly when the dollar sort of fell away a little bit, and now settling back at 94, there seems to be stability. As far as the wholesale business is concerned, that yes, there is sensitivity around the exchange rates. The way we manage that is obviously by way of forward cover and pricing. I think that the key, obviously, as far as brands is concerned, is to be able to have brands that have got power and have got the ability to set prices. Now, naturally, I understand we're in a global market, but brands like Merrill and Soccer League do have the ability to set prices and are price setters rather than price takers. But we are able also to mitigate those issues around exchange rates by the increasing volume in our businesses. With the growth that we're experiencing through our brands, you obviously get operating leverage through those brands because you have smaller fixed costs and a variable cost element.
That being said, we should all be careful what we wish for. The newspaper always says we would like an 85 cents to the dollar. At 85 cents, there'll be substantial inflation coming through. In every sector, so I'm not sure if you're better off with a weak dollar or a strong dollar. Different industries will be in a different position, but inflation will come through in a lower dollar.
Thank you. Well, I think that's the last question, guys. Last year we had Greg Ellis. I haven't told the guys this. Greg Ellis from realestate.com, and he came in, and I think the share price might have been $25, $26 on the day he presented, and it's $48 today. So we've set the bar. No, in truth, what I love about the business is it's as Hilton said earlier, strong cash flow, strongly profitable, but with a conservative balance sheet, no debt. A lot of dividends to shareholders. The guys are focused on the things that are important. We might not see the share price double over the next 12 months, but I think we're in good hands. So thanks, guys, for coming along.